So welcome to today's presentation, Predictable Investing, how to generate monthly passive income with 300,000 and make 30% a year. So my name is Eric. I'm a chartered professional accountant and also a chartered investment manager. In this video, I have put in a lot of value, lessons, tips, and tricks so that you can master investing as well and generate monthly passive income for yourself. So let's get started. So first of all, this is not a get-rich-quick scheme. This is not a do nothing but click a button and make money. And this is not day trading or investing in penny stocks to get rich. And if that's what you're looking for, this webinar is not for you, and you can pretty much click off right now. So my name is Eric, and I graduated from UBC, and I also got a master's degree from University of Saskatchewan as well. I'm a CPA and chartered investment manager. So I previously worked on multiple startups. I'm also a speaker of data analytics with a data science and a machine learning background. So I worked in one of the biggest four accounting firms, KPMG, as an auditor for over 8 years, and I also helped private equity funds or hedge funds buying assets around the world for 3 years as well. So I achieved my financial independence and retire early goal by 30. And right now, I'm working on starting 2 hedge funds, and the goal is to raise 50 million each. And the target distribution is 20% a year. So that's my project for 2025 to 2027. So that is actually applicable for RRSP and TFSA, and US for IRA account and cash accounts as well. I'm also raising capital for my startup, Investing Accelerator, so early investors will get 20% dividend a year. And for this webinar, I'm mainly going to focus on teaching you how to invest so you can apply these strategies yourself. But if you're interested in me investing for you, then the link is down here, free demo for investors. So the traditional finance retirement plan requires you to save for a majority of your life to get to $1 million, and then you take out 4% a year, which is around $40,000 a year. Now this strategy works, but it's quite capital intensive, it's not enough for retirement, and it's possible but very tough to save $1 million because basically you got to work all the way to 65. So there's got to be a better way to do this whole retirement thing. And after having over 1,000 calls, I realized most people can retire with 100,000 a year. And we want to achieve that goal with as little capital as possible. And I figured that out with 300,000. If you make 30% return a year, that's around 100,000 a year. So this requires a lot less time in terms of saving, and what you need to do is to get a better investing strategy. So for 2024, my return as of December 1st is 46% for my long-term index funds. I call it the Smart AI Index Fund, which will be used to create the hedge fund. And then for the monthly passive income strategy, it's 1 trade a week, and it's 55% year to date as well. So you can see that for 2024, it is a bullish year. And usually, on average, I target around 20 to 30% return a year. So for the monthly passive income strategy, my target is 30% as well, 3% a month. So 1 trade a week. So in the last 5 years, I have helped over 550 students. 160 of them made 30% from their first investment, and there's over 800 successful exits in the program. So 40 students made over 100% from a single investment. So that's a good achievement as well. So on the right-hand side, you'll see that a couple of students posted about their portfolio gain in 2024. So Flo, she's a lawyer in Australia, made 45%. This is using the monthly passive income strategy. Anthony made 61% in 12 months, and this is using a more long-term strategy. And then for Edward, made 50% in 2023. That is a mix of long-term and monthly passive income strategy as well. So let's talk about the top 5 problems with investing. So the first one is most people don't do any analysis before investing. So they might do some technical analysis, but they often ignore fundamental analysis. So you need to learn both technical and fundamental analysis, including income statements, balance sheets, and cash flow. So that is like the minimum you need to master fundamentals. Now, in terms of fundamentals, it can be quite time consuming. So most people use multiple days just to analyze one company. But as a CPA with over 9 years of experience, I know quite a few shortcuts that can help you analyze fundamentals very quickly. And usually you can get it done within an hour. So later on in this webinar, I have 2 historical coaching calls where I go through multiple examples on how I analyze fundamentals and the shortcuts I use, so you can watch till the end. Now, number 2, most people invest, but they buy at a price that is too high or not buying stocks at a discount. You need to have the right tools, basically indicators, to help you find discounted stocks. And that is really the principle for long-term investing, is to buy low, sell high. And one of the statistical tools I use to identify discounted stock is Bollinger Band 2,20. So if you don't know what that means, that is the parameter for this indicator, which I'll go over on how to set it up later on in this webinar. So basically, it looks at the last 20 periods of data, and it helps you visualize where the price ranges 95% of the time. So to teach you this tool, I need to bring you back to high school math, where you first saw the bell curve. Basically, it's the distribution of data points. And when we are investing, we want to focus on data. We want to make logical decisions, not emotional. And you're basically looking for when the price is outside of the normal range, which is near the lower part of the Bollinger Band. So here you can see the red rectangle, which is the 2 standard deviation of the bell curve. So the probability of that happening is like 5% or so. And when that happens, you want to buy. So how you set this up, which I'll go through this in detail later on in this webinar, is that you go to tradingview.com, which is the charting software I use. You go to the indicator tab on the right-hand side, search Bollinger Band, and then click add, and the default parameter is already 20,2. So you just click add, and you should see it on Apple looking like this. And basically, whenever it is close to the bottom parts of the band, these rectangles you see here, that's a good time to buy. And for this stock is Apple, and you can see that over the last 2-3 years, there are 4 or 5 opportunities to buy Apple at a discounted price. So for long-term investing, buying stocks at a discount is crucial. Problem number 3, most people invest long-term, but there's no mechanism to multiply your profit. Now, this ends up pushing you to invest in higher risk stocks that are less proven. For example, penny stocks, small caps. Previously, people invested in electric vehicle stocks, and a lot of them tanked. So to achieve 30%, you just need to focus on big blue chip companies, plus a discounted price, like I showed you earlier, and a profit multiplier, which is using options. So for the last 3 years, where I worked with some of the biggest private equity funds in the world, this is how they invest. They look for big companies at a relatively good discount, and they use leverage on it. So Stacy, she's a consultant in San Francisco. She used to invest in UK bond that only gives her 1 to 2% a year. And then after she learned investing in Investing Accelerator, she made 33% from Starbucks in 4 months and 40% from Disney in 11 months. So these are blue chip companies. And you can see her testimonial here. Mary, accountant in Australia, used to only get 1% from savings accounts. She invested in Aritzia, a Canadian clothing company that is also expanding to US, and she's making 42% in 18 months. Caroline, controller in Vancouver, Canada, and previously she was day trading and her results wasn't consistent. After she learned investing from me, she made 79% from Meta, Facebook, and then she made 90% from Intel in 5 months. So these are, again, blue chip companies. So let me give you a quick crash course on options. Now, when you're buying options, it's like buying shares or buying a house, and you just put a down payment, and basically you're paying interest to multiply your return. So for long-term investing strategies, you can use options to multiply your return, and you can usually 2x to 3x your return. So if the stock goes up by 10%, you can get 20% using options. Problem number 4. Most people only focus on long-term strategies, but have no solution for loss protection or even making money when the market is going down. So the solution is that you need to learn both long and short strategies in order to protect yourself. So during the 2022 market crash, the ability and the knowledge to use protective options is quite useful. And when it comes to a bear market, it happens once every 5 years. You might not know you need this knowledge until a couple years from now, but if you have it in your toolbox, you'll always be ready to protect yourself during a bearish year. So you know it's coming, but you just need to have the knowledge to protect yourself. And you only really need a small amount of money for hedging. So for example, less than 5% of your portfolio. And if you do this right, you can hedge 50% to almost 100% of the downside. So here are a couple of case studies where people are hedging PayPal, and then she made 37% increase on the account, made over 300% on the PayPal hedge. Air Canada gained 300% using a put option as a hedge. So on the right-hand side, Disney, Mike also hedged for 100% profit, and then got a new hedge because Disney kept going down during that time. And then Sherry here, GPN put at 32%, which is also a hedge to protect her downside. So by knowing both long and short with option strategies, you can protect yourself when the market is going down. Problem number 5. Most people focus on making capital gains, but they don't have a method of generating passive income. Now, to generate monthly passive income, you need to learn option strategies that give you interest. So basically rent once a month. And if you execute this successfully, it should take you around 1 to 2 hours a week, especially if you copy or follow some of my trades as well. The traditional finance people always push you to say, oh, you want capital gains because it's lower taxes and whatnot. But as you get closer to retirement and you need to find ways to replace your income, this is where the monthly passive income strategy becomes increasingly important. In fact, it is the most popular strategy in my program because people who are getting close to retirement realize that they need to figure out some way to use a small amount of capital to replace their income and then leave the rest in long-term investing. So that requires you to sell options. So that's like offering a loan or collecting rent to other investors, and you receive interest premium. So for example, the monthly passive income strategy, we sell options once a month and get you 2 to 3% a month, 20 to 30% return a year. So the formula is quite simple. Blue chip company at a discounted price, plus technical and fundamental analysis, plus selling monthly options, that will get you the 2 to 3% a month. So the probability you're aiming for is a 90 to 95% win rate, and this is based on the tool I developed within the program. And all the tools I use are either developed by myself or there's at least a free version of it online. Now, for my advanced monthly passive income strategy, we just do 1 trade a week, 3% a month, and the year-to-date return for this strategy in 2024, it's 55%. So that is a pretty good return. It is above our targets of 3% a month. For my co-founder, Michael, he's also using around 200,000 on a monthly passive income strategy, which basically gives him around 5 to 10K a month. Bonus tip number 6. Most people overestimate the amount of capital they need to retire. So typically, my clients have the following goal. So they want retirement, cash flow, and then they want financial freedom, basically less reliance on their full-time job, especially with high inflation right now, with AI replacing a lot of jobs in the next 5 to 10 years. You need a way to generate monthly passive income using the capital you have. Traveling, so that's usually for people who are close to retirement, and you can make money anywhere that is not bound by a location. So I actually get a lot of clients that are in the real estate space, like realtor, developer, that wants to generate additional income to substitute their existing earnings. And finally, kids' education. College is expensive and competitive, so you need to save up early and also generate income for that. So when it comes to investing, if you want to retire in the next 5 to 10 years, then you can use my long-term strategy plus the monthly passive income strategy. Now, if you don't need the income right away, you can start with the long-term stock options first. And as you get closer to retirement, you can switch over to the monthly passive income strategy for a more predictable cash flow. Now, if you're super close to retirement or you are retired already, then you just focus on the monthly passive income strategy, 1 trade a week. And once you get to a certain level of cash flow, then you can allocate some back to the long-term investing strategy. And then if you're investing for kids' education, financial freedom, traveling, or retirement in general, monthly passive income strategy is what I would recommend you to focus on. So how can retirement be achieved within the next 5 to 10 years? So let's say you're starting off with $100,000 and saving $1,000 a month, making 30% a year. So if you reinvest your capital, within 4 to 5 years, you'll get to a $300,000 portfolio, and making 30% return a year, that'll be $100,000 a year. So most people can retire here, so that is great. And for people who want a more ambitious lifestyle, like if you're from New York, then you might need more capital and then make 30% on that. So once you reach your retirement goal, whether that is using long-term investing in a retirement account, or if you just have the cash saved up, you can switch over to the monthly passive income strategy to create a predictable cash flow stream for yourself. So for example, if you're investing $100,000, then your monthly income will be around $2,500. If you're investing around $200,000, it'll be 5,000 a month. And then if you're investing somewhere around 300,000, then it'll close to be 7,000 to 8,000 a month. So most people should be able to retire in that area. And then the rest of your capital should be used in long-term investing like index funds, a couple of blue chip stocks at a discounted price, and so on. What is the minimum investment you need to use my strategy? So I usually recommend people to start with at least 20,000 to 30,000. Now, if you're using the monthly passive income strategy, I would recommend you to start with 50,000, aiming for 3% a month, so that is 1,500 a month. And then once you get more confidence and skill, then you can scale up. The absolute minimum is 10,000, but I don't really recommend it because you need to put in some effort to place the trades, whether you're copying mine or finding your own. I would recommend you to start with 50,000 if you can. So at the end of the day, I think we can all agree, no one wants to lose money in the market. No one wants to feel like they're gambling in the market. No one wants to get 7% or less in the market because S&P 500 is like 8%. And no one wants to risk their life saving on penny stocks or day trading. That's why we focus on blue chip stocks. So what do you need to succeed? So there are 3 key ingredients to success. You need guidance from someone who has done it before. And this can be in the form of video coaching program that takes you from stock picking, researching, entering to multiplying your profits. You need guidance over the investments you want to buy. So especially the first couple of investments, because that's usually the most difficult. Once you understand the workflow, everything becomes a lot easier. And you need to know people who have the same strategy as you, because there are a lot of investing strategies out there and it can get confusing very quickly. So you need to learn from someone that has the same strategy as you. So in the last 5 years, I've helped 550 students, and you can see their results on this page. Quite a number of them made over 30% in 2024. For my own return, my smart AI index fund strategy is 46% year to date, and my monthly passive income strategy, 1 trade a week, is 55%. So if you follow every single one of my monthly passive income trade once a week, your return should be around 40 to 50% as well. My long-term target is 20 to 30% return. So let me introduce you to Investing Accelerator. There are 3 components to Investing Accelerator, the coaching program. So first is a step-by-step video coaching program, and you learn long-term stock options and monthly passive income. There's weekly group coaching calls where I analyze the latest stock ideas and give you the overall market analysis in terms of like a monthly forecast. So whenever I buy or sell for long-term and monthly passive income, I email you as well. And there's also a Facebook community where you can ask questions and you can see how other students are doing. So first part is the 7-week video coaching program. So you can watch this anytime, anywhere. It's a step-by-step, click-by-click video. So my strategy is long-term, shares, index, stock options, and monthly passive income as well. So you'll learn the best in terms of technical, fundamental, risk management, portfolio management, insider, option, and exit strategy. So I've made this program fairly straightforward, so you don't need to have any financial background in order to use this strategy. So in terms of time commitment, it's around 4 hours a week for 7 weeks, and the time commitment going forward is around 1 to 2 hours a week. And here's a screenshot on what the program looks like. There's Investing Accelerator, there's the weekly coaching calls, and then Val here, she's an analytics manager in Vancouver, Canada, and in the past few years, she was focused more on career development and only think about wealth management recently. So when she had a chance to explore some of the potential strategies, she was overwhelmed. So she was only getting 8%. And then afterwards, she joined the program. She mastered investing fairly quickly and made 35% from a Canadian auto parts company using stock options. So here's some food for thought in terms of long-term versus short-term. So do you know which time frame is the easiest for beginners? Do you know which time frame is the most reliable? Do you know how to find safe and stable companies that grow year after year? Do you know how to take advantage of these companies when they're at a deep discount? So in terms of technical versus fundamental analysis, do you know the 2 most important indicators in technical analysis and the pitfall of technical analysis? And do you know how to manage and limit your risk when investing in the markets and have a systematic exit to capture your profit? And do you know how to extract information from 300 pages of financial statements in 30 minutes or less? And do you know how management manipulate the financial statements and how to avoid a stock when the CEO and CFO are dumping the stock? And that's really where the insider analysis comes into place. So applying the formula. So do you know how to find blue chip companies at discounts using an hour a week? How to invest and multiply your profits using stock options? how to find the best strike expiry date that controls your risk while maximizing your return, and how to minimize your diversification and maximize your return using leverage. How difficult is it for you to find a good answer to the questions I just mentioned? If it is difficult or very difficult, then this program is for you. So the second part is the weekly group coaching calls. So this is where I gather the stock picks from other students in the program, and you can send me any stocks you're looking at as well, and I would analyze it during the weekly group coaching call. So for example, analyze 3M, Take-Two. Recently, I looked at Lululemon, Microsoft, Google, Apple, and basically I give you a much more detailed forecast. We look at technical and fundamental analysis together and which option you should use and when is a good time to buy a specific stock. So if you don't have any ideas, other students will submit their ideas and also include my ideas during the weekly group coaching call as well. So you should have plenty of ideas to invest. So Daniel here, he's a CFA, a banker in Vancouver, and he has been studying finance and he couldn't figure out options, even though he has a CFA background. And after he learned investing in the program, he made 38% from Activision and Blizzard using stock options, 70% from Intel in 5 months, and 61% from Johnson & Johnson using stock options as well. So you can watch his testimonial here. Now, in terms of monthly passive income trades, I share 1 trade a week with you. So to generate monthly passive income, you just need 1 to 2 trades a week, aiming for 3% a month, 30% a year with a 90 to 95% success rate. So you can see that I post the exact trade you need in the community, so then you can place it when the market is open on Monday or Tuesday. For the private Facebook community, that's when you can ask questions, you can post your results, and you can see how other students are doing as well. So this will speed up your learning. And whenever you have any questions, you can just email me, send me a message, or you can post in the community as well. So usually I respond quite quickly within a day. So Arian, aerospace engineer in Canada. So previously he wasn't sure if he can master investing in stock options, and he couldn't pull the trigger until he joined Investing Accelerator. After that, he made 72 from Activision and Blizzard. He made 100% from NVIDIA, and he's actually the 3rd student making over 100% from a single investment in my program, and 93% from Align Technology in 3 months. So this is the trade where Yves made $17,000 from Activision and Blizzard in 3 months. For those of you who are interested in being part of Investing Accelerator, there will be a button below for you to schedule a free strategy session with me or my co-founder, Michael. So there's 2,900 people registered for this webinar this week, and we have 40 spots for the free strategy session. So if you're very passionate about investing and you are interested in having more control over your retirement and generates monthly passive income, then you can click on the button below and schedule a strategy session. So during the call, we'll walk through exactly how you should allocate your portfolio, if there are any significant changes you should make to optimize it, what is the amount you need to allocate to generate your desired monthly passive income goal for retirement, and if you have any questions, you can ask us as well. So both myself and my co-founder Michael are a chartered investment manager, and I'm a chartered professional accountant. So I would love to hop on a call with you and go through your situation. Now up next, we'll be going through a couple of modules in Investing Accelerator for free. So I'll teach you how to set up your chart and add the indicators I showed you earlier onto your chart. So this will help you with long-term investing. It'll help you with finding discounted stocks. And I'll also walk you through multiple examples on how you can analyze a stock as well during the weekly group coaching call. And you can also see how the monthly passive income trade work, which is 1 trade a week, so it's pretty straightforward. And once you go through the lessons and you master the strategy, you can just copy or follow my trade, which makes it a no-brainer, and the entire process will make sense to you. So let's get started. Welcome back to Investing Accelerator. In this module, we're going to talk about the overall approach in terms of investing and also setting up your chart along the way. This is when I'll introduce you to the very first tool, which is our charting tool, and it is free. Now, as of this point, you should have gone through the mindset module. You have started to open your account, or you have your account all set up, and you have set up your list as well. I'm very excited for you because this is really the first step into the investing journey. The overall approach has 5 steps. The first step revolves around technical analysis, which stands for analyzing price action and price patterns. This actually acts as the filter to basically eliminate any stocks that is not ready to be invested yet. In this step, we look for stocks that are on a discount, and if it is not on a discount, then we just skip over it. The second step is fundamental analysis. Once we find a stock that is on a discount, we'll dive deeper into the financial statements, the performance of the company, to see whether it is actually a good opportunity. We'll also supplement that with ratio analysis, insider, and news. What we're doing here is really trying to paint a full picture of what is going on with this stock and the market as well. By the end of the fourth step, you'll be 95% confident to invest in this stock, or you think this stock is not good enough and you're going to look for another opportunity. If you decide to invest in this stock, then you'll figure out how to buy options, which is the fifth step to multiply your profit. Now, we are going to set up your chart. There are 3 steps we're going to go through. The first one is we're going to make an account in tradingview.com, which is our charting tool. You might have a charting tool of your broker, or you have a preferred charting tool somewhere else, but this one is free. This is the best charting tool I have seen. Now, I'll also share my chart link with you here. You'll see the link down below this video as well. You can see what the chart is supposed to look like. Finally, I'll set it up with you step by step within this video. So we can get started. Let's make it simple. First off, type www.tradingview.com and go to this main website. Now, when you get to this website, you're going to see that there are a lot of things going on. But the first step is really to click sign in. Or if you see on the right, you should see join for free or something. Now, if you click on that, you'll actually be able to start now here with basic. If you see the join for free button, then you can also log in as well. Now, if you don't have an account yet, then you actually can click sign up, and then you can sign up through a variety of means, whether you're using your Google, Facebook, or email. Once you sign up, you'll get a confirmation link in your email. You just click confirm, then you should be logged in. Now I have logged in, and this is my test account. Right now, you're going to see there are a lot of things going on, a lot of things that are ticking. What's important is that first, that there's some sort of news feed or chart feed going on in the middle, that there's a watch list, something detail about the stock, and also some news. If you look here, the bar, you'll find ideas, markets, scripts, screeners, streams, broker, and chart. The most important one is the chart. That is basically the key function we're going to use from TradingView. We're going to get other functions from other websites in terms of news and financials and so on. Right now, just click on chart, and this will bring you to your chart. If this is your first time setting up your chart, it's going to look something like this. If you already have an existing template, then it will look slightly different, but I'll set it up with you from scratch. As of this point, if you look at your own URL, this is actually your chart URL. And you'll see that it's tradingview.com/chart/this unique code, which is your chart. If you want to bookmark this page, you definitely can. If you actually take out this latter part of the URL and go like www.tradingview.com/chart, you will get to your chart as well. Here it actually brings you back to this chart. Now, if you want to take a look at my chart, just to show you what we're trying to get to, you can click on the link below, and let me open a new tab. This is the chart we're trying to get to. Right now, you'll see that it is a view-only mode. You actually can't edit this chart. This is what we're trying to get to. And you'll see that there's a lot less going on. It's much cleaner, and it gives you exactly what you need in order to identify an opportunity or not. In the later videos, I'll actually explain what each of the lines mean, so don't worry. If you're using a free account like I am, then you want to go through the step-by-step instruction to set up your chart. That was one of the first modules of Investing Accelerator, where you learn how to set up your account. Next up, we have 2 video testimonials. One is Florence, a lawyer from Australia, and another one is a banker from Vancouver, Canada, Daniel. We can hear what they say about Investing Accelerator.
Hi, my name is Flo and I'm from Sydney, Australia. I'm currently working as a lawyer in the city, and I joined Investing Accelerator in April of this year. And it's been a short 4 months, but it's been a really eye-opening journey for me. So before jumping into that, before Investing Accelerator, I was mainly just focusing on finishing my law degree, but I decided to started investing last year. I bought another course that I felt would help me along my way to my financial freedom, but it was actually really time consuming, and I felt that, well, for the amount of effort I was putting in, the returns wasn't that great. So earlier this year, I looked for another investing course, and luckily I came across Eric's content on Facebook and YouTube, and I decided such a passive approach and such great returns, I thought, why not try it? So I did, and in April I joined the course, and in mid-May I made my first investment in Activision Blizzard, and I actually sold half of it last week at a 60% profit, which I'm really happy about, and the other half I'm still holding on to with a 70% profit, and the whole portfolio as a whole is sitting at 40%, and it's only been 4 months since I started my investing journey with Investing Accelerator. So it's been really wonderful, and the investing side of things has really fit into my life really easily, considering that I work full time. I don't have a financial background at all. For anyone that has doubts about whether they can learn and understand content, you shouldn't be afraid. I'd say for anyone looking to join or interested in investing, I'd say go for it. Don't hesitate with Eric's course. It's the real deal. The amount of support and that you get with Eric and the community is great. And no question is too silly. We're all here to learn, and it can really change your life. And I'm just really excited about the future now with my portfolio, and I'll see what happens.
Hi, my name is Daniel. I'm from Vancouver, Canada. I currently work at HSBC, and I do MI reporting for their retail credit department. Before joining Eric's team, or Eric's program, I was always involved in investing, but the Investing Accelerator program and Eric has helped me to increase my returns and also improve my investment results. I really enjoy working with Eric. He's a great guy, and he produces results and gives you the confidence in order to place trades and make good investments. Prior to joining, my investments were doing okay. They were making money, but after joining Eric's program, I was able to increase my profits a lot faster. Eric gives you the tools and knowledge and helps with the confidence and the analysis so that you're able to place the correct trades, and by doing so, you're able to bring in profits faster than you would without his help. One of the great things I love working with Eric is just his support, and placing trades sometimes can be quite difficult, and placing investments and making investments, and sometimes it takes a little bit of courage. So Eric's great because he's always there, and his weekly coaching calls, he addresses a lot of the questions, and so any issues or concerns that you may have with your investments, he's always there looking out for you. So it's like having that safety net below you before you take the leap. You can be confident that your investments will turn out well because you have that second person behind you. After joining Eric's program, I've cashed in on one investment so far, and that was on Activision. It's made about a 38% return, and I was holding that investment for about 5 months, so just under 5 months. So I made 38% return in 5 months, which I think is pretty good. It's been better than any of my other investments for that short period of time. If I was to give one piece of advice for a new investor or someone thinking about the program, is just to go with your gut and trust your gut and the analysis that you've done. That because you've done the analysis, you don't need to hesitate. And just for myself and my personal experience, hesitating on a few of the trades and the investments have costed me some profit, especially after doing the analysis with Eric. Just the hesitation has caused me to be late in some entries or not even being able to take an entry because the stock already moved in my favor. So trust the system, don't hesitate, and invest wholeheartedly. That would be my advice to anyone thinking about the program or anyone who is investing, new to investing.
First of all, you'll see that at the bottom bar, there are some E's and D's. So this stands for earnings and dividends. We actually don't need that. We're going to right click and uncheck dividends, right click, uncheck splits, right click, uncheck earnings. So first off, we clear the bottom bar so it looks cleaner. Now the next thing is that on the upper left corner, there's volume. When we're investing, we actually don't need to use that. We can get rid of it as well. Then we can actually start modifying this chart. If we right click on the white space, then you can actually get to something called settings. Right now, we're going to change the outlook of the chart. Here, you're going to see body, which is under symbol. I'm going to use a white candle for up and a black candle for down. That means I'm going to choose white here. That's the green candles turn white. And for the red one, I'm going to choose black. This is really just what the industry standard is. What I personally feel is cleaner. Here, I'm going to choose black for borders and also wick. This should give you a fairly clean chart. Once you have finished modifying the chart colors, you should see that it changes in real time and it looks like this. Then afterwards, we'll go down to status line. And I think we can leave this, not worrying too much about it. We can go to scales. We can keep that as well. And once we get to appearances, you'll see vertical grid line and horizontal grid line. This is actually something we don't want because we want our charts to be simpler and less clutter. We'll change the color to white. Now you can see that the background is completely cleaned. And in terms of trading, since we're going to be using our own brokers, we actually don't need this at all. So we can deselect positions, orders, and we don't need to show execution as well. This one is important, show buy or sell buttons. You can uncheck that as well. If you uncheck it, on the upper left-hand corner, this should disappear as well. In terms of events, I think we cleared that out earlier. Here you also see show economic and events on chart. You can actually deselect that as well. So in the end, you have a very clean chart with just black and white candles. Now it's time to add our indicators. If we go up here, you'll see the symbol. For example, right now is Apple. Then you're going to see a D, and this stands for the time frame of your chart. I'll explain this in a little bit more detail in the later videos, but basically each bar you see here stands for 1 day. When we are investing, we want to take a long-term view. We want to use 1 week. And this is pretty much the chart we're going to be using throughout the entire program when we're investing as well. If we click 1 week, this is really the charts we're looking for in terms of the time frame. I don't recommend using any chart below 1 day. So personally, I just use 1 week alone to invest. And I don't use any chart below that because it is too volatile. The lower the time frame you go, the less reliable the chart is. So 1 week is what you're looking for. Now in terms of candle, or in terms of this little button, it gives you different types of charts, like bar, candle, whole candle, line. We're mainly going to stick with candle. That's pretty much all we need. Then afterwards, for compare, you can just skip that. For indicators, that's what we want to add. We click on indicators, and basically we're adding 3 indicators in total. The first one, you can type BB, or Bollinger Band, and you can see it right here. You just click on it once, and then you will see the Bollinger Band showing up. On the upper left-hand corner, you'll actually see BB as well here. So that's how you know you have added one successfully. The next one we wanted to add is really EMA. This is really the short form called EMA. The long form is actually called Moving Average Exponential. So in the past, I used to be able to type EMA and this will show up, but now you actually have to type the full name, Moving Average Exponential. For this one, you want to click twice. So you will add 1 EMA, and you will also add a second EMA. So here on the left-hand side, you'll see that there are 3 indicators now, which is 1, the BB, 1 EMA, and another EMA. At this point, we are good. And now we need to customize these individually. When you go to the BB band, you're going to see that there are 4 buttons, which is hide, settings, source code, and remove. There's also one that is more. But basically, if you click on hide, then you can actually hide the indicator temporarily. We'll be using that later on for the technical analysis videos. For this one, we really want to just click on settings and just clean it up a little bit. Right now, you'll see the input is 20 in terms of length and standard deviation as 2. So that is what you're looking for, which is just the default. In terms of style, you're going to see that everything is currently checked. So basis, upper, lower, and background. We don't need basis, which is actually the middle line here. I just unchecked it. This is the middle line. And then we also don't need the background. I'm going to uncheck that. What you're going to get is the upper and the lower blue line as BB. I think we're happy with that. So we're going to click OK. Now afterwards, then we want to customize the EMAs. We click on settings again here, upper left-hand corner. Right now, you'll see that the style is blue. For this one, we really want to customize it to 100 EMA and make it red. So I'll choose red. In terms of the line, I think a line is fine. What I really want to choose is the thickness. And the thickness, I want to choose the 3rd level. That's usually thick enough. You can choose the 4th level if you want to, but 3rd is good enough to see. Afterwards, in terms of inputs, we want to change the length to 100. So on a weekly chart, this means you're looking at the exponential moving average for the last 100 weeks, which is approximately 2 years. Then you click OK. So then you see that there is this line right here. Afterwards, you can go here and click on settings again for the second EMA. And this time we want to do 200. This means the last 4 years average in terms of this chart. And in terms of the color, we use dark blue. So we can use that one. And for thickness, we'll choose the 3rd one again. You can actually use a darker blue if you want to. So that's just personal preference. As at this point, these are all the indicators you need, which is the last 20 weeks for Bollinger Band, 2 standard deviation, 100 EMA, which is the last 2 years, exponential moving average, and 200 EMA, which is the last 4-year moving average. In the later technical analysis video, I'll go through these indicators one by one so you'll know exactly what to do with them. Right now, I'll just explain a little bit more about the user interface so that you know what everything is. In the upper right corner here, you're going to see that this is unnamed. It might be something else for you, but what this is the name of the template. We can actually rename this template to be something called Investing Accelerator. So then you can click Save, and you can see that the name is now updated. And you can see the cloud has a little circle around it. But then every time you click on that or you make a change, it will actually save. Make sure this is checked once you exit the chart. Then it will save all your progress, all your analysis, all your lines as well. Now on the right-hand side, you're going to see a watch list. If you look to the rightmost bar here, then you're going to see there are a lot of little icons. So most of the icons we're actually not going to use. For example, like alerts, data window, these other things. We actually don't need any of it. You just got to click watch list, which is the very first icon. You're going to get a pre-populated watch list from TradingView. Now, in the previous video, we already covered what your watch list is going to be. We actually don't need any of the pre-populated stuff. What we're going to do now is actually to take this out. You see this little X button here on the right? Just keep clicking on that until you get rid of all the stocks here. Now, you have a clean list. And what's important is that you put in your stock symbols into the watch list. For example, I can type FB, which stands for Facebook. Then that is added. And I can also type AAPL, which stands for Apple. That is added as well. If I click Facebook, then you can see that it actually just goes directly to Facebook. And on the upper left-hand corner, it is Facebook as well. If I click here, Apple, then goes directly to Apple. Now you can pause this video, take a minute, and add all the stock symbols you found earlier into this watch list. We should have around 10 stocks to 20 stocks to be added here. Now below here, you'll actually see that there is a very small card of what the stock is about. For example, the price for Apple. If you go down a little bit, it'll also tell you what's happening on whether the market is buying or selling the stock. You don't want to look at that too much because most of the time you actually want to do the opposite of what this little card is telling you, and you'll learn how to do your own analysis, so then don't worry too much about it. You can see that there is a little bit more stats here, but you actually don't need this card. At the bottom here, you'll get some headlines for Apple. This is actually quite useful. When we go over the news module, then we'll dive deeper into how you can read news and use that to your advantage as well. Now you can add the stocks onto your watch list, and I'll see you in the next one. Now you have gone through another module of Investing Accelerator where you learn how to read the chart. And it's really important for you to schedule a call. You can click on the link below and go to 5minuteinvesting.com/book strategy session. Find a time that works for you, and then remember to fill out the survey so then your application is complete before the call. So next up, we have another 2 reviews, and these 2 are both engineers. One is Benson from Vancouver, Canada, and another one is Arian from Ontario, Canada.
Hi everyone, my name is Benson. I live in Vancouver, Canada. I am an engineer working in the software industry. So before I joined Investing Accelerator, I did not do any investing, but as I started working and getting more income, I felt the need to start doing some of my own investing and making my money grow. I had no idea how to start, so I was very new to investing. I wanted to invest in stock. So my friend Eric, who is the founder of Investing Accelerator, he was the one who taught me how to invest, how to look at the charts, and how to find a good stock to buy. He put all his knowledge in Investing Accelerator, and I took that program, and it taught me how to properly do research in the stock market and to risk assessment of all of the stock that I wanted to buy. So after joining Investing Accelerator, I made over 100% return in some stock that I purchased in previous years. I have become much more knowledgeable in analyzing the stock and how to read the charts. I know how to research on the stocks to buy now, and I know how to research in the stock market. One advice that I would give to the new investors that want to join this program is to focus your investment in companies or industry that you know and are familiar with. For me, I was more familiar with the tech industry because I work in that tech industry. So majority of the stocks that I purchase are in the tech field. You don't have a field that you are familiar with. That is fine too. After joining the program, it will teach you how to properly research on the stock, and you will be able to find a field that you'll be familiar with. And that's it. Thanks for listening.
Hello, my name is Arian from Montreal, Canada, and I'm an engineer at an aerospace company. And I'm here to talk to you about Eric's Investing Accelerator program. So before joining the program, I've never invested before, but I've read books and taken many online classes. So from what I've read and what I've learned, I really like the aspect of long-term investing and also the option side of it. So when I stumbled upon Eric's program, I thought it was really perfect for me. So after going through the program, it gave me enough confidence to basically invest in my very first stock, which is ATVI. So I entered in March and exited not too long ago, September. And I pretty much gained 71%. So it's really exciting. And I'm really thankful that I have gained this knowledge. So thank you, Eric. So just a piece of advice for everyone that's just joining in. So I would say be consistent with your analysis, be thorough, don't skip any steps, trust the system that it works. Also, go through the coaching calls and get into Eric's mindset of analyzing the stock. So that really helped for me, and that's it. I think enjoy the process and good luck to everyone. Bye.
So welcome back to Investing Accelerator, and in this module, we're going to talk about technical analysis, a good time. So by now, you should have your chart set up from the last video, you have your stock list inputted, and now it's time to do some analysis. And technical analysis is really the study of price patterns. And we want to make sure we get into a stock at a discount that will grow over time. Okay, so one of the first components of the chart is actually the weekly chart, which is the time frame itself. And I only use the weekly chart. I don't use daily. I don't use anything below daily as well. And this is the best and the easiest time frame for profitability. So first off, let me explain what a weekly chart is. So if you go to TradingView, then you're going to see that on the upper left-hand corner, there's a W. And if you follow the steps correctly, this is what it should look like. And if you look at each of the boxes here, it's called one candle. And each candle represents a week. So if I move my cursor, this is December 16th, December 23rd, and then December 30th. So each of them, it's a week. And when you're using a weekly chart, time moves by very slowly. So this gives you a lot of time to think. This gives you a lot of time to do other stuff, like for example, you have a full-time job and you're busy. And this also allows you to plan ahead and be patient. And the chart is not moving so quickly that you need to react to it. So instead, you're more proactive, and it also allows you to do more in-depth research. When it comes to technical analysis, we'll be using indicators and tools. And when you think about timeframes, you can actually use this on any single time frame. So you can use it on a 1 hour chart, which means every bar is 1 hour. You can use it on a 1 minute chart, which means every bar is 1 minute. But I think the biggest concern when it comes to using a lower time frame chart is, first, you need to be sitting in front of the computer all day, which we don't want to do. And second, it is a lot easier for the big hedge funds to manipulate the lower time frames. And that is crucial because imagine I have $100 million or $100 billion, doesn't really matter, and I want to invest in a stock, and I buy a lot in a very short amount of time, within 5 minutes, let's say. That is going to significantly skew the chart, and it will break all the technical analysis patterns. But if you are using a weekly chart and you invest in big blue chip companies, then it's much harder to manipulate the chart itself to give people a false signal. And if you actually study some of the great day traders back in 1960s and so on, one that comes to my mind is actually Jesse Livermore. Once you have accumulated enough capital, it is actually possible to manipulate the lower time frame charts, so then you can basically make other investors feel that the stock is going down when in fact you're trying to accumulate position within the stock. It is possible to do it for penny stocks, it is possible to do it for small caps, and it is possible to do it for lower time frames, but it is much more difficult to manipulate the chart if you are using the weekly chart. And that's why when you are using a weekly chart, it is a lot safer. And when you are analyzing the patterns that I'm about to teach you, it is a lot more reliable as well. So again, the lower the time frame you go, the less reliable it is. And for many years, I've been using these low time frames. I even use seconds, minutes, hours for sure, and day, and I never use weekly. And during that time, I wasn't very profitable, and it was very difficult to make money. And when you think about the market, there are a lot of players in there. And there are a large group of technical traders and a large group of day traders. And the lower the time frame you go, the more competition there is. And the higher the time frame you go, the less competition there is, which is easier to make money because you want less competition. So when it comes to investing or trading in the short term, I would say the market is fairly efficient. It means that there isn't much advantage for you to invest short term. And that's very important because hedge funds or other funds, they actually have supercomputers to trade the stock at a second or even less than a second level. And this allows them to have an advantage over other hedge funds. So as you and myself as retail investors, it's impossible for us to trade at the second level or even millisecond level. So if you are day trading or whatnot, then you'll be at a huge disadvantage to machines because most of the time right now, people are just relying on algorithm trading in terms of short-term and day traders. So we focus on a weekly chart, and this will protect us over the long term, and it is much easier to achieve profitability as well. Okay, so then now we can start looking at the chart. And there are mainly two components to it. And what we're trying to do is really to analyze this price pattern. You can see it go up, it's going up and down. So then we want to know whether A, there is a trend, and B, whether it is a good time to enter, which is getting in at a discount. And this really goes to our fundamental understanding of price. Okay, so let me come back here. And this is the first important concept you'll learn in terms of technical analysis, and it's actually probably the most important concept. So from the previous chart, Apple, you probably see that price is doing something like this. And there are a lot of different patterns that people try to convince you to use. There are a lot of different indicators out there. There's over 300 indicators. If you just go here and you click indicators and you go to build in, then you'll find that there's like a ton of indicators. Which one are you supposed to use? Now, of course, within this course, and for my personal investing as well, I only use 2 indicators and you have it on the charts already. And the reason is because once you understand the 2 components of price, then you realize you only need 2 indicators. So this is what a general price chart looks like. It looks like an ocean wave with a certain direction. And you are right. And if you break down the components of price into its individual components, then what you're going to get is, first, a direction. Now, the direction can be up, down, or horizontal. Okay, so this is the first part. And then you also get the volatility, or the fluctuation of the stock price. So that means you can go to any chart and you can break out the 2 components of price fairly easily. And there are only 2 components, which is actually a crucial observation. So if I go back to Apple here, then you can see, okay, the first component, which is that direction, is up. And then if you look closely, then you can actually see the small waves, okay? So some of them are a little bit larger and some of them are smaller. Okay, so because there are only 2 components of price, that's why there are only 2 indicators, which is the first one is called the EMA, and we'll cover that in this video. And the next one is Bollinger Band, which we'll cover in the next video. And this is such an important observation because when you go on the internet and you research on other technical analysis strategy, you'll realize that they have been adding like 5, 6, 7 different indicators onto the chart. But that is like saying to yourself, I need to identify the trend and I need 5 indicators to do that. So that means there's a lot of duplication if you are using more than 2 indicators. You know, another way of saying it is I'm trying to identify the volatility and I need 5 indicators to do it, but you don't. You really just need 1. And if you have 1 indicator for the trend and you know it very well, like the pros and cons, when you're supposed to use it, when you're not supposed to use it, and 1 indicator for volatility, which again, you know when to use it, when not to use it, then you're going to be in a fairly good shape. And in terms of technical analysis, you're going to be miles ahead of other investors while keeping your chart extremely clean. So in this video, we're going to dive deep into trend. And what is a trend? A trend is really what happens when you hold on to a stock for a period of time. So what does that mean? Let's say I'm holding on to Apple. And here you can see that Apple has an uptrend as of the moment I'm recording this video. And if I hold on to Apple for the last 5 years, I would have made money. If I hold on to Apple for the last 5 years, it would be growing. So that has a positive trend, and that means the price is going up. So that is really the definition of trend. Now, if there's no trend, then if I hold on to the stock for the last 5 years, I would break even. So that has no trend. If I hold on to the stock for the last 5 years and I lose money, which means the stock price is down, then it has a downtrend. So it's fairly simple. And it is such an important concept because if you hold on to a stock that has a horizontal trend, then holding it longer doesn't make you more money. Being a long-term investor doesn't help if you hold on to a stock that has a horizontal or even worse off, a downtrend. And you'll actually find stocks that have a downtrend when they pay a high dividend or when they're struggling in the market in terms of their business model and what they're doing with their customers. So we'll go through a couple of examples shortly. Now, there are mainly 2 techniques you'll learn here for identifying the trend. So the first one uses no indicators at all, and we just use our eyes to spot the trend. And I'll show you how easy and simple it is. And if the trend is not clear, then pretty much you can just move on to the next stock. And it's called the 45 degrees technique. And a second method is the EMA, which is the exponential moving averages we just added last video. And you can use the EMAs to quickly spot the trend, because sometimes it can get tricky because the stock can be shifting from a downtrend to an uptrend. And if it does not have a good trend, again, just move on to the next stock. And what we're doing with technical analysis here is really using it as a filter, because we're trying not to waste any time on stocks that are flat or have a downtrend. So you want to focus your valuable time on stocks that are growing and have a good trend. And this will maximize your impact, which in return, it will be higher. Okay, so first off, let's practice the first technique. And I'm going to hide the indicators here on the upper left-hand corner, which you can just click on the little eye here, which will hide the indicators. So here, now we have a very clean chart. And the first technique is the 45-degree rule. And what it is really saying is, if you see the price going from the bottom left to the upper right corner of the chart, then that is an uptrend. That's how easy it is. So now you got that done, okay? So literally, that was it. And if I go to another stock, we're going to go through many examples here. Google, bottom left, upper right, 45 degrees, that's an uptrend, okay? So I'm using easy examples to start, and then later on we'll dive into some complicated ones. Nike, again, a very strong company, global brand, uptrend. Now the next one is Accenture. So let me just get rid of this notification. Accenture, and here you can see it is an uptrend. It is a consulting company. And whenever you see that there's a stock with an uptrend, then you want to move it upwards. So what you will do is you will drag this up. So if you drag this up, then naturally the best stocks, the ones with the best trend, will surface to the top, and then the ones with the worst trend will surface to the bottom, or will fall to the bottom. So for example, at the very bottom, I have a stock that looks like this. I'm probably going to delete it, but it doesn't have a good trend. Okay, so the next example I want to pull up is Disney. Now here, you can see that the trend is a little bit less strong. And the reason is because Disney is very mature and the growth is slowing, and there has been a lot of things happening with Disney lately. And as of the time I'm recording this video, this is actually the coronavirus, which you can see that it has a big drop, and we'll cover more of that in terms of how to identify the bottom in the next video. Now the next stock is EA. And here you can actually see it has an overall uptrend. And something big actually happened here. And I actually got into EA at around $80 something. And then later on, I exited with more than 50% return. And the best thing about trend is that the more you hold on to it, the more money you make. And if you continue to hold on to a stock with an uptrend, over time, most of the time, like 90% of the time, you will be making money. And we'll actually cover this in the exit module, but the longer you hold to the stock, the more money you will make as long as it is in an uptrend. If it is not in an uptrend, then the longer you hold, the less money you will make, or you don't make any more money. So the next one is Johnson & Johnson. And here, you can see the trend itself is not very strong, but it is still an overall uptrend. So it's obviously not as strong as something like Apple or Google, but then you do see an uptrend. And in the next video, we'll talk about how to identify a bottom. So then this will help you out a lot more when it comes to a stock like Johnson & Johnson, where you see a lot more fluctuation than trend itself. So by now, we went through quite a number of examples, and you can actually go through your stock list as an exercise to see whether they have a good trend or not. And for stocks that have a good trend, go to the watch list and move it upward. So then you can start surfacing those good opportunities to yourself. And you want to compare the trend and the strength of the trend. And in the next video, you'll also take into consideration whether the stock is at a high or at a low, so then that will further sort your list nicely. Okay, So I think it's pretty obvious what an uptrend is. And now we're going to dive into a couple of what I call bad examples. So for example, if you go to Baidu, which is actually the China version of Google, you'll find that actually it doesn't have a good trend. So here, you can actually see the stock price is actually going down. And I would consider this to be a downtrend. And that's why I wouldn't invest in Baidu. Another one is HSBC. And here, you can see that it used to have an uptrend. Maybe not, it's horizontal. But for the last couple of years, HSBC has been falling a lot. And this is mainly because the business itself fundamentally is struggling. And this is reflected in the price. And you can see that this is dropping. And if you bought since 2018 up till today, any time, regardless of how good you are at timing, regardless of how good you are at fundamental, if the stock price has a downtrend, you will lose money. And you can see it very clearly here that there's no way you would have made money in terms of a capital gain for HSBC. And another thing is HSBC is giving a high dividend, which is why it has a downtrend as well. Now, the next one is ExxonMobil. And right now, we're in the middle of the coronavirus market crash as I'm recording this video, so we definitely need to take that into consideration. But what's more important is that the oil price is also decreasing as well. So for ExxonMobil, which is an oil and gas company, you can see how it get impacted. And for the last couple of years, since 2016, it has been in a downtrend. So anytime if you have bought ExxonMobil up till now, you would have lost money because it is at a downtrend, regardless of how good you are at timing. So that's why the trend is very important. Now, there are also a couple of stocks I want to go through that are more flat in nature. So this one is called Dollar Tree. Here, you can see that it is actually flat. It doesn't follow the 45 degrees rule. So then it means that you need to focus more on fluctuation. And the next one is Box. And here, you'll see that for Box, this is like the drop box for businesses. And it has been a flat trend. So that means even if you hold on to it for a longer period of time, it might not necessarily go up. The next one is really Line Corporation. And this is a messaging app from Korea that is really popular within Asia. The mascot is a bear. So if you know what it is, they actually have a store in New York selling some goods. So you can see that overall, so far to date, the trend for Line has been flat. So that means, again, if you hold on to this for 5 years, it doesn't necessarily mean it is going up. Now, of course, for a company like Line, where it's technology focused, you need to look at the financial statements and the future of the company to see if whether there's any room to grow. So we'll actually cover this when we go to the fundamental analysis module. Now, the next one is really Toyota Motor, another big blue chip. And here you can see the trend is up, but I would consider this to be flat. Because if you zoom out a little bit, then you can see for the last 5 years or so, the trend has been pretty much flat. If I bought here on average 125, right now I'm at 130. So there isn't that much growth. So again, the trend is fairly flat for Toyota Motors, and that's why I don't invest in it. And the next one is really Twitter. And Twitter, you can see that right now it has a slight uptrend. And that is really because for the last couple of years, Twitter has been becoming profitable. But before Twitter becomes, when I say profitable, they're making revenue. I need to check the financial statements to see if they're actually making positive net income. But if you zoom out a little bit, then you'll see that Twitter actually doesn't have a very strong trend. And this is more like flat. And you can see that it used to be at a downtrend because at first it was very unprofitable. And then later on, once they figure out how to charge people for money in terms of advertisements and so on, then you can see that the stock price has increased / stabilized a little bit. And if you look at this, then what you see right now, it's actually a change in trend. So it goes from downtrend here, and then it's a little bit upward / flat. And sometimes if you're just using the 45-degree rule, it is not very clear on what the trend is. And that's why we have indicators to help us. So this brings me to the second point, which is EMAs. And exponential moving average is what we added to the stock charts earlier. So then we can go to TradingView again, and this time we will unhide the EMA. Okay, so the blue EMA stands for 4 years, the average for the last 4 years, and the red EMA, which is 100 EMA, stands for the average of the last 2 years. Okay, so right off the bat, when you are looking at trend, we'll use an easy example first before we dive back into Twitter, which is the more difficult example. So for AAPL, you can see here, the price is generally above the 2 EMAs. So that's an uptrend. And if we want to be very strict, then I would say if the price is above the blue EMA, I would consider that to be an uptrend. So here for Apple, it is very straightforward. Using the blue EMA, within just 5 seconds, you can see that it is an uptrend. It's a no-brainer. For Google, again, price has been consistently above the blue EMA. It's an uptrend. And Nike, you can see price has been consistently above the blue EMA, so that's an uptrend. Now here, you actually see that price has been dipping between the red and the blue line for a couple of times. And that is why I don't use the red line to determine the trend. We actually use the red line for another reason in the next video, is to identify the bottom. And when you look at these strong trending stocks, you can actually see the distance between the red line and the blue line gives you how strong or consistent the trend is. So the more width between the 100 and the 200 EMA, the more consistent it is. And that's actually good because you want a stock that has a consistent trend, and this gives you an indication of support. It means that there's a lot of people that are buying consistently and the stock has been going up. And let me go through one more that is a good example for Disney. And here you'll actually see that price occasionally dips below the blue line, which is actually quite rare in this case for Disney. And you can see actually it doesn't really happen except for the coronavirus market crash, okay? So this is an exception. So when you're evaluating Disney, you actually want to exclude that and just look at it before. And you can see there is an overall uptrend and price rarely touches the blue line. And you'll learn more about what it means to touch the red line and the blue line in the next video. But in this video, we focus on identifying the trend. The next one is Johnson & Johnson. And here you can see again, the trend is fairly strong. Now, if you go search online or if you study a little bit more about moving averages, online some people will actually use the crossover of the moving average from red to blue to identify the trend. So personally, I don't think that's a good idea because this is a lagging indicator. So that means that by the time the red line crosses the blue line, it's too late. The trend is already very apparent. Okay, so I'm going to use another example, which is Baidu. And for Baidu, you can actually see that price has been below the red and the blue line for a very long time. So since 2018, here for the last 2 years or so. And you can see there is actually a crossover, which then people will consider from this point onward, it is a downtrend. But it's not a very good indicator because you can see it has been dropping for a whole year before this crossover occurs. So if you see people panicking about the crossover, I wouldn't worry too much about it. What's more important is where the price is relative to the blue EMA. And the next one is HSBC. And here you can see that the distance between the red and the blue line is actually quite small. And then you can see price has been below the red and the blue EMA line. So that means the longer you hold, the less money you make. And this is very true if you actually bought here for $42 and HSBC's business is struggling, you would have lost 50% as of right now. And it only makes sense because the trend itself is down. So that's HSBC. And ExxonMobil, here you can see that for the last 4 or 5 years, the trend has been down. So here you can see that regardless of your timing, it is actually very obvious once you put the EMA lines there because the red line is actually below the blue line and price has been consistently below the blue line. Okay. And I have a couple more examples in terms of a change in trend, which we can go through as well. But you might be wondering, why am I using 100 and 200 EMAs? Why am I not using a 10 or 20 or 50 EMAs? And the reason is because the longer the EMA, the more reliable it is. So for 5, 10, 20, 30 EMAs, these are shorter term. And people use it mainly to identify the fluctuation, which if I go back here, this part, the second part of the price, But we have another indicator for that, which is called Bollinger Band. So we actually don't need a short EMA. So then what we're left with is we want to identify the long-term support for the stock. And if you look at the technical analysis market, another factor that I considered is how popular is a certain indicator. Because when you're using EMAs, you are obviously analyzing the long-term average, but what's more important is you're actually peeking into what a technical analysis trader would think. Because if I'm a technical analysis trader, I'll use 100 and 200 EMA. And that's actually what's popular in the market. So if I am analyzing the stock as Eric per se, and I look into the markets, I would know that the technical analysis people out there will be using these two levels of support. Most of them will, and they'll think that it is reliable and strong. So then we know that a group of people will be purchasing when it is interacting with the EMAs. So we'll actually talk about timing more in the next video, but the popularity of the indicator is also a factor I consider when using it on the chart. Okay, so the next part, we're going to cover a couple more examples on when the stock is changing trend. And a classic example is really Twitter. Now, personally, I'm not a big fan of Twitter. I rarely use Twitter. And for the longest time here, you can actually see Twitter has been struggling. So I'm just going to zoom out a little bit so you can see. And it has been going on a downtrend, and it makes sense. And with the red EMA, it's consistently above the stock price. And after a while, it has been forming like a bottom. It has been horizontal for 2 years. And then you can see stock prices going past this point. Now, when it goes past the red EMA, there are actually two scenarios that can happen. The first scenario is it's actually just horizontal and it keeps going horizontal. And the second scenario is that it is actually a change in trend. So in this case for Twitter, I would say for this part is really a change in trend. But if you actually look at the big picture, it is more horizontal. Okay? So in this case, that's when it becomes tricky. And that's when you need to have a deeper understanding of the company, because just because the stock price crosses over the red or the blue line, it doesn't necessarily mean it is a true change in trend. You will need to do a little bit more research on it, but then it will give you a good indication. When it first change in trend here, around $20, you can start doing your research on it. Now, when it comes to change in trend, from a business perspective, what that really means is a business was struggling from a strategy perspective or from a financial perspective for a long time, like Twitter, and somehow management is able to change the strategy or change what they're doing and make it profitable or make it grow. So that will usually lead to a change in trend. And when you think about it, this is really like a restructuring or a turnaround situation. And in my mind, a turnaround situation that is successful, it's quite rare. So that means the probability of a turnaround situation is low. And I would say it's around 10%. So out of 10 companies who wants to turn around, one will succeed. So you can immediately think, actually, the probability is against you. When you are looking for a change in trend, which actually a lot of people do because they think the stock is really cheap and suddenly it's going to go back up to really high, the probability of that happening, it's actually around 10%. And let me show you a more extreme example. So HSBC. Now, when people are identifying tops or bottoms in a downtrend situation, they think they can easily predict a change in trend. But that's not usually the case. For example, here, I could have bought in 2018 October, bought here, March, and bought August. And I would always consider that it is cheap because the stock price is dropping even in April. But if you look at the number of times the bottom has occurred and it is failing, then you can see that the probability of you successfully guessing the bottom for HSBC is quite low. So just out of these, let's say 5 bottoms, all of them failed. And let's say the next one is really the true bottom and somehow you got in at the absolutely cheapest price. Then you can see the probability is less than 20%. So that's why it's so important to invest in something that already has a good trend. And if you are investing in somehow a turnaround situation, then you need to be extra careful. Now, I want to introduce you to another stock, which is called Shake Shack. And Shake Shack is really an East Coast burger company, and they make delicious burgers. And they went IPO back in 2015. And there was a lot of hype because they thought Shake Shack is going to be the next McDonald's. And then the hype died down. And then now you can see there's basically a downtrend for the first 3 years of its IPO. And then it crossed over to the red line. And I've been watching this stock for quite a while, and I really like their products. I am a big fan of Shake Shack, and I go and eat there quite often, so I know their product is good, so it's just a matter of expanding. So after they crossed over this line in 2017, I actually did quite a bit of research, and I realized that, oh, actually they are expanding into the China market. So when they are expanding into the China market, what does that mean? It means that revenue is growing, their business is growing, and net income will be higher. So that will lead to a higher stock price. So I got in at around this level, around 37 to 42 in early 2018. And you'll learn more about how to do financial statement analysis and so on. And then afterwards, you can see there is a change in trend. And this crossover was the indication of that. And then afterwards, it reacted to the red EMA here, which we'll cover more in the next video. And then the stock price went up. So Shake Shack is a good example where the trend has successfully changed and then made a good profits on it. But there are also situations where it's not the case. And whenever you are investing in a turnaround situation like this one, you need to be very sure that you're right, because most turnarounds are not successful. I'm trying to think to see if there are other examples I want to show you. For example, BlackBerry. And BlackBerry is a mobile company. It's used to be selling phones. It used to be better than iPhones. It used to be the dominated player within the markets until iPhone came out, and that completely destroyed BlackBerry. And if you zoom out, you can see that, wow, the trend has been down for many years. And they try to turn it around many times for BlackBerry, but it is just not working out. And in the end, it used to be what, $150? Now it's at $6. And you can see the trend is down. And unless you know that BlackBerry's business is fundamentally changing, the stock price is not going to go back up. It's not going to turn into an uptrend. So that's why it's so important for you to look at the trend, invest in stocks that have a good trend. So then this means the longer you hold on to it, the more money you will make. So that is pretty much it for this video. Now, before you jump over to the next video, I would suggest you to just take 15 minutes to scan through your list and just move the stocks that have a good trend upwards and move the stocks that have a downtrend to the bottom of the list. So this means the best opportunities will be near the top. And then once you go through the second video, which is the next one, on timing and how to find the bottom, then you will naturally surface the best opportunities to invest and do more analysis on. Okay? So I'll see you in the next video. Now you have gone through the technical analysis module of Investing Accelerator, and that really puts you ahead a lot of investors that try to use technical analysis but couldn't figure it out. Up next, we have Caroline from Vancouver, and she's actually a controller, and previously she was day trading, but she wasn't very successful. Now, when you're ready, there are a couple of spots left for you to book a strategy session. You can have a personal one-on-one call with me and to understand whether you're a good fit for the program.
Hi, my name is Caroline, and I'm from Vancouver, British Columbia. I joined Investing Accelerator last year in October 2018, and I started my first trade with Facebook options when there was a huge drop, and I entered my first position in November 2018. I just closed my options trade last week in May 2019. So within 6 months, I made 79%. And I'm super, super excited about not just this trade, but the potential of many trades that is to come. My life prior to Investing Accelerator was in Forex, shares, and also options. I was into doing short-term trades as well as daily trading. However, it was a huge stress for myself. I also hold a full-time job, as well as trading in the evening and early in the morning. For the efforts that I have put in, the return was not significant. That was my life prior to joining the Investing Accelerator. After I joined the Accelerator program, I realized that sometimes you can still make a decent, in fact, a very good return without engaging in frequent trades. And when you have a peace in your mind, and you will be able to see the opportunity better. And the most important element of trading that people do not notice at times is the time. You need to let the time to do its job. And for the short-term trader or the daily trader, they thought that they can get in and out of it and have so much stress in their life and might even encounter health problems for some of my friends. So I'm super excited that I joined this program and learned all the skills that Eric taught and be able to carry it through. After I placed the trades last year, although the trades was not doing too much initially, but my stress level has also not been so high. And when you give the time into consideration, after 6 months, your investment will be realized. For myself anyway, sometimes it might take longer than 6 months, sometimes it might be shorter. But overall, I'm super happy, and thank you, Eric, for such a wonderful course. I give this rating a 5 out of 5, definitely for anyone who do not want stress and anxiety in their life, and simply let the time and let a good investment run. Thank you.
So the next couple of moments, I want to give you a sneak peek of what it is like to attend one of the weekly group coaching calls in Investing Accelerator. In these coaching calls, we actually go through stocks in detail. We answer any questions you have. We have this coaching call every single week. So welcome back to February 9th, 2024 weekly coaching call for Investing Accelerator. So this week, I'm going to quickly go through the market, very bullish, and talking about stock pick submission in general. Next week, it's going to be inflation, and I expect to be overall positive because we're going to be below 3% for the first time. Monthly passive income. And then I've added a couple of stocks here just to give you a range on what to expect for entry. Crocs, Lulu, McDonald's, Starbucks, and EG, Everest. So that is the rundown for today. As always, you can skip ahead to go to the stock you want. So let me just show you the overall summary here. So you can pause this video if you want to. So we can start. So right now, S&P 500 is extremely bullish. RSI is 82. So the overall market is up. And if you have already entered into your position, your goal is just to hold. So a lot of you are asking, oh, what is the price target? And when should I expect to exit? And when there is such a bullish market, it's not about a specific price, but it's about when the momentum is dying down. So the reason why I keep putting the RSI number here, which is actually the RSI number here, is for you to keep track of the momentum. So as long as it is above 60, above 55 is generally bullish. So you want to keep holding on to it until it comes back down to 60. So you can see that S&P 500 continues to go up, and the Bollinger Band is expanding. So this is actually a major bull trend. So you gotta go back one step and think about these ones. And as long as the RSI is generally above 55, 60, you can continue to hold on to it. And if you want to be a little bit aggressive, you can actually hold until it is 50, and you will still capture 80, 90% of this trend. So it's very important that you don't exit too early. And if you do exit, you can always park your cash in SPY and QQQ until you see the next discounted stock. And in this coaching call, I do go through quite a number of discounted stocks that you can invest that are relatively safe in my opinion. All right. So that addressed this. S&P 500 is too high, but it's actually not. And the rest of the market is going up, but Apple, one of the blue chip stocks, is still lagging behind. So Microsoft is going up quite a bit, but I think it should start to slow down soon and may reach a short-term top. And then the rally will be picked up by Apple, which will further move S&P 500 higher for the month of February. So we should see some movement for Apple in the next 3 weeks and up till early March. Okay, so I think that the rally for SPY and QQQ will be sustained for now. Now on a stock submission issue, so recently quite a few of you want me to review loss-making companies that are high growth or with a downtrend. So I'm talking about Plug, Palantir, Neo, PayPal. Now this is usually a sign of heated markets when you see big techs being at all-time high. And this pushes the regular investor, instead of investing in SPY at a high or Microsoft at a high, you start looking for these cheaper stocks that are maybe lagging behind and maybe the price is lower as well. And this leads you to investing in companies with lower profitability or loss-making, or even companies in China, and which is currently under US sanctions. And this means that you're taking on higher company risk, hoping for a run-up. So let me just show you what enticed people to invest. So Palantir. Previously, it obviously had quite a strong downtrend, and with the recent AI craze, it announced its earnings and it jumped from 16 to 24. So you can see this kind of movement is what catches people's attention. You might want to chase into it, and the company's profitability might not be that great, but compared to things like Google and Microsoft, psychologically speaking, you might be more inclined to invest in these ones because you're trying to catch that quick move. Now, the problem is because when a bear correction hits, let's say in mid-March, they announce interest rates decline and suddenly the market is worried about it, then the weaker companies will drop first. And that's actually what happened in the last cycle, because when these big tech companies were at a high, more and more investors pushed towards these second and third tier tech companies. And during that bear market, all these tech companies went down and never recovered. So PayPal is a bit of a special case, but you can see that since the drop, PayPal is super cheap, but the downtrend sustained and it actually never recovered. So this is the kind of issue that happens when there is a bearish correction. And this is how you end up with a portfolio of bad or loss-making companies, is because during the bullish or heated wave, you start looking for more and more opportunities that are in the high-risk sector, hoping that they will pick up some momentum because the rest of the market is so high. And when the correction hits, these companies go down first. And then Apple and Microsoft and whatnot, they go down last. So you already know it wouldn't fit with investors, investing accelerators criteria. So only invest what you feel comfortable. So usually in a portfolio of $100, you should have $10 or less in high-risk companies, and you might just choose one high-risk company. And the rest should still be in index or / blue chip companies that are at a discount. So you need to be very careful when you're investing in these high-risk companies. So for example, in my portfolio, I don't have any at the moment. And I would rather invest in things like Google, Apple, even just SPYQ at a high, instead of trying to chase these lower profitability companies that have a sudden jump. And these jumps are usually triggered by earnings, and which can be 50-50. So for example, you have Palantir that have a significant jump, let's say I think it's around 20-something% in 1 week. It's actually more like 1 to 2 days because after earnings. And then you have something like Snap where they have really bad profitability and it went down like 20-30% in 1 day. So on one hand, yes, there are opportunities where you can make a lot of money, like 20% in a day. But on the other hand, this can equally happen. So it's more like a 50-50 most of the time when you're investing in these second, third tier tech companies. And it doesn't mean you cannot invest in them, it means that you should limit the amount to invest in them. And it wouldn't fit with investing accelerators criteria, so you need to be comfortable with the risk. Okay? All right. So the short answer is I think Feb and March, SPY and QQQ will continue to go up. So when you need to be careful is mid-March. Then I think that's when you need to be a little bit more careful. So let's look at inflation. So previously, inflation was 3.33%, and my estimate was 3.4%. And the month before is 3.14%, and my estimate was 3.45%. And what you see here is the inflation index actually coming down. So this is actually 306.7. And we can see that, hey, the prices are actually not increasing. And for the next month, which is the January inflation, which is going to be released February 13th, next week, I use 307, which is slightly higher. And chances are it's going to be flat or slightly declining. And my estimate is 2.6%. So I think the actual inflation might be closer to 2.5, 2.4%. And if that is the case, this is actually the first month the inflation dips below 3%. And during the January meeting, Powell said that they need to see inflation heading towards 2%, which is actually what it's going to be doing next week, to cut rates. Now, what's interesting is that this will be obviously bullish for the market, which is why I expect the market to continue to rally for February, next week onwards. And then for the month afterwards, if the inflation index stays the same, the inflation number will be 2.06%. Now, chances are it's going to be closer to around 306.5. So we're actually going to be at 2%. And this is going to be released again in mid-March, which will be before the interest rate decision, March 19th. So I think the rally will keep going right up until March 19th. And when they announce the interest rate decision, that's when they first cut rate. And then you might get like a small correction or like a slight flat month for April. So that's what I'm expecting before the rally continues. Okay, so I think overall this year is going to be quite bullish. If you don't exit in March, I don't think it's a super big deal, because then the next month is 1.72%. And this will basically trigger the rest of the interest rate cut. And I think people will even start betting that Fed will cut interest rate faster than previously expected. Because if you look at the month following, and here I'm already using 308, which is actually quite high. So I just fixed some of the numbers here. So in April, I'm using 308, which I consider to be quite high, because if we're going for a deflationary trend in the short term, then I think it's going to be 307 more likely. So this is going to be below 2% for March, April, and May. And I think that will give Fed the bargaining power, per se, to lower the rate. Okay, so if there is anything going to be happening, it's going to be the March 19th interest rate decision. So for now, you're just going to be keep holding on to the stocks you have. Alrighty, monthly passive income. So here, QQQ continues to go up, so it's fine. And right now, Nike is actually 104. So it's actually quite far away from the 96 one now. Upper strike, so that's fine. And then Lulu 435. So this one is fluctuating a bit, but it did bounce off the 450 level. So this is. And then for last weekend, I emailed you Apple, which currently is at a relatively good discount. So I think 170, 160 is okay. And I think for the next couple of weeks should be bullish for Apple, so that should be fine as well. All right, so let's talk about some of the long-term stock investing selection, so you can go from there. So the first one is Apple. I put this back on the list. Previously, we got it at 182. If you want, I think somewhere between 200 to 180 is fine. So basically this box here, I think is a good entry point. With the recent earnings announcement, the market or Apple, the stock itself is moving upwards, even though it's not moving up a lot yet. But this is basically a pin bar during the earnings event. And before that, there's another slight dip. So this is actually a very small W on a daily basis. So it's actually easier to see on the RSI here. So you can see there's a very small W. So if you enter, for example, this week, next week, then I think you can capture the Feb rally. And with entering Apple somewhere between 180 200, you're aiming for 225 to 250 by the end of the year. So if you want to use a leap, I think that's okay. And basically, I think there is a good amount of upside for it. Now, the next one is Google. Some of you already entered, which is fine. I'm just putting it out here. So previously, the stock dropped after the earnings, and now it's actually quickly catching up. So 135, 145, but right now it's 149 because it went up today. So if you need to get in below 150, I think that's okay as well. The next one is Crocs and Lulu, which I'll be going through during this coaching call today. But basically for Crocs, so I put down 100 to 85. It actually went up slightly, so it was 105 today. So if you want to get in, I think below 108 is okay. I'm just going to extend the range for you slightly. And next week is actually earnings. And after you read my analysis, you can see whether you think it will jump or not. And I personally think it will go up. Lulu. So this one is a bit tricky. So right now it's just hovering within this area. And my target here is a little bit too conservative, 420, 450. But it just bounced on 450 this week. So I think chances are if you can get in around 460, 465, which is right now, I think the price itself is okay. And again, you also want to enter before earnings because I think the earnings is quite good. All right, and if you don't like these semi-discounted stocks, then you can always hold SPY and QQQ, and you can park it for the rest of the year, which should be overall bullish. And I expect QQQ to reach 500 this year. All right, so let's go through the first one, which is Crocs. Want price projection and analysis of upcoming forecast earnings. So let me just zoom out for you so they can get a feel of it. So the overall trend is actually strong, and the bottom itself is mature, and you can see there's this giant W formation. And right now it's starting to pick up, and the Bollinger Band is expanding. RSI 53. So right now it's closer to 59 today. Mature bottom, annual financials growing with some income tax fluctuations, but not a concern. Quarterly growing. So Crocs fell earlier due to 2023 guidance, and earnings is coming up next week, February 15th. The company has a very low guidance, and Wall Street expects Crocs to beat it. And I think it is okay to enter before earnings to see if there's a jump. I think the chance of Crocs jumping up is very high. And if you enter before earnings, you can use shares to be conservative. If you want to use options before earnings, remember to save some cash to enter afterwards in case the earnings go against you, or you can use a small hedge. So this mainly depends on how aggressive you want to be. Like if you're very confident that Crocs is going to jump up from this 106 level, then I think you can go ahead and use a leap. If you're concerned, you can always enter a small hedge and then for a month or two expiry. And if it does go down, then you would use that money on a hedge to average down, or you can buy something else. So I think it should be bullish for the first half of the year at least, and I think you will be aiming for 140 to 190 for exit. So you're aiming for around here, 140 to 190. So basically, I think Crocs is likely going to reach either this medium-term high or the all-time high, which is 190. So somewhere around here. If it does jump up, then you're basically going to be close to getting to 120, 130 already. So 140 shouldn't be a big problem if it does jump up. So then the question is whether you will hold for another couple of months to see if it will breach this upper high, 150, to get to this 160, 180 area. Okay. All right, so let's quickly go through the analysis. So strong trend, mature bottom, growth, cash is declining, and debt to equity ratio is 3 times, which is slightly higher than usual, which means the stock itself will fluctuate more. And potential stock price, I put down 85, 105, and you can use a strike of 70. So because this week is quite bullish right before earnings, I think if you use 70, that's good enough. If you want to be a little bit aggressive, you can use a strike of 80. But if it does go down, you need to have the resilience to hold on to it. And you can add more if you want. All right, so there's some grants, some sell here. Now, the growth itself is very strong, which is good. And for Crocs is really one of those things where their marketing strategy is very well, so a lot of people love the products. And then overall, there is an increase in net income. And here there is some income tax fluctuation, which is why if you look at pre-tax income, you'll see a much nicer trend. So I wouldn't worry too much about the income tax. Now for quarterly, you still see growth overall, 1.05 to 985. And then in terms of net income, overall growing as well. Now for debt to equity, it's around 3 times. And the cash balance is slightly declining, but I'm not too worried about it because the company is growing and profitable. So previously, they cut full year revenue outlook. So that's why it went down. So this is back in November. And this time, here you can see the company guidance is actually very low. And Wall Street is expecting a much higher level, basically beating company's guidance. So I think they're going to be doing okay. And earnings February 15th. And there is long-term options. So if you want January 2026. So basically, the 2 things you're relying on to succeed is A, for the earnings, you're expecting it to go up, which I think there is a very good chance of it happening. If you want to be safe, you can use a small hedge. So in case it does go down, your hedge would pay off first. And the second one is strike 70, 80. I think that's good enough. And the next one is the exit point, which I think you can aim for at least 140 for now. And if it is very strong and for some odd reason does break this 140 resistance level, then you're aiming for this 160, 180 level. Okay? So the next stock is Lululemon. So the RSI, let me just quickly update it. It's 53. So recent strong winter sales. So I think they're actually beating records in terms of the amount of sales they're getting. And I expect them to beat earnings. And the earnings is coming up March 26th. So I think there should be a jump here. So right now you're still maybe 1.5 months early. So you got a bit of time. So December 2023 downgraded by Wells Fargo. And it is going to be volatile. So the bottom may form somewhere between 420, 460. So a good chance will bounce on 450, which is right now. Okay, so let me just go to the chart to show you. So right now, it just bounced on 450 this week. So if you feel like, hey, you might miss out and you don't think it's going to go to 420, which I do think is a bit unlikely, you're probably going to be getting like 440 or whatnot if you're very accurate. Then you can enter at 460. I don't think you need to be too fussed about the super absolute bottom, but you do have 1.5 months before earnings. So you can probably wait maybe 2 weeks. Try to enter incrementally if you want to get in at a better price. But I feel like 460 to 440 is where you would want to get in mostly. Now the option might be expensive, so check to see if it is within your budget. But I think if you use a strike around 350 to 400, then I think that would be good. So a strike of 400 will be very aggressive. So if in a bad scenario where the bottom is actually 420, then I think your strike 400 will be quite aggressive. So that's why I suggested 350 for the strike. But you can see this is actually quite wide. So that means your option will end up being very expensive. So you can evaluate if that is within your budget. So if it is not, then you can just use shares. But I think you're basically trying to get in somewhere around this 450. So if I go to the daily charts, you can see the lower Bollinger Band, red EMA, it is at 450. And right now, it's hovering in this area. So if you see it hovering in this area, maybe like for 1 to 2 more weeks, then you can just get in at around 460, 450. So I think the chance of getting to this 440, 430 level will be quite low. All right, strong trend, forming bottom because you're still 6 weeks away from earnings. Sell, growth, with some seasonality, downgraded by Wells Fargo. All right, so here, insider sell, nothing too surprising. And the growth is quite strong. And if I go down here, net income is growing as well. Now, in terms of quarterly, overall is growing. And I think their winter sales, which is this upcoming quarter, is going to be quite good. So again, I think they're going to beat some records. So for net income, it's flat when you compare quarter to quarter. But I think for this coming earnings, it should be fine. For balance sheet, good amount of cash. That's okay. And in terms of debt to equity, it's around 0.7, 0.6. So I think that's low enough. So I think that's fine too. Okay, so January 8th, the fourth quarter forecast fell shy of analyst estimates. March 26th is the earnings date. And obviously it's going to be beating last year, but I think it's going to be beating the estimate, more importantly. We'll see. Yeah, so there is long-term options. So basically, I think it's just a matter of waiting to see if you can get closer to this 450, 460 area for entry. From an RSI perspective, it is already near the bottom. If you look at the previous bottoms, it's around 50 RSI. So I think it's okay to enter. If you want to be conservative, stick with stocks. So the next stock is McDonald's. Annual financials, 2022 profits are down, but 2023 is up, which I'm not too worried about 2022 because that's a while ago. Q4 had a decline of revenue compared to previous quarter, mainly due to seasonality. Has share buyback. Earnings. McDonald's dropped due to sales miss. So McDonald's reported its first quarterly sales miss due to the Middle East, China, and India boycott campaigns over perceived pro-Israeli stance. Starbucks also cut its sales forecast due to similar issues, but it bounced back quickly. So if you can't get a good price, then just use shares to buy and hold. So I think it is okay to use options on McDonald's. Strike 250. So previously it looked like McDonald's was going to go towards 270, but it bounced back within a week. So McDonald's plans to expand 50,000 stores during Investor Day. So this is actually back in December. So I think overall you're going to get some good growth trajectory for years to come. And I feel like, yes, you can enter now between next earnings as well. So I think let's look at the technical analysis first. So right now, McDonald's kind of formed the top and RSI is heading into the negative territory. So when you're looking at the bottom, I put it as forming. And the growth is a little bit volatile and it has negative debt to equity due to buyback. So that's fine. And if you're using a strike, I would suggest 250. And if you're aiming for stock price, 270, 280. So previously, when I was doing the analysis, it was closer to around 285, but right now it's 290. So I think realistically, you're probably going to get a price somewhere around here. So somewhere between 280 to 290, I think that's good enough. If the next week you see the stock is going down, then I would try to aim for 280 to 275. So if next week is starting to head up already, which may be surprising because the inflation is coming down. For McDonald's, they mainly target low-income customers, so that actually might work against them. But we'll see. So if it does head down to around this 280 level, then I think, yes, you can aim for this 275, 280 area. So this is actually my initial suggestion on where you would enter. But that was before yesterday where it suddenly bounced back up. So I think if you aim for this area, it should be pretty good in terms of price. Initially, I was expecting it to bounce off the red EMA given a couple of weeks. So somewhere between today till the next earnings, it might reach this area. So if that is the case, like if you get in somewhere between 280 to 270, then the strike you want to use is around 250, which is a blue EMA. So I think that's a conservative enough strike. And then at that point, ideally, you want the RSI to be heading back up. So if it does head down and start turning around, then that's the perfect time to enter. So there's some grants, which is okay, with some sell. And in terms of the financials, here you can see it is fluctuating, but overall increase. And for profitability, does fluctuate, but overall increase. And in terms of quarterly, even though they have a sales miss, let me just pull up the December data because it wasn't released here. So 6406. So even though there is a sales miss, it's actually overall increase compared to last year, December, which is 5.93. So you can see McDonald's itself is very strong, which is why it bounced back so quickly. So the opportunity to enter was a very small one to get in at the lowest price. So you just gotta average it out if possible. So yeah, decent net income. There is a slight decline compared to last quarter, but that might just be seasonality. So let me just take a look here. So compared to December last year, it's still an overall increase, which I think it's okay. So if you're looking at the seasonality chart, kind of the earnings by quarter, then here you can see for the next quarter is expecting to be slightly lower due to seasonality, and then the next increase will be even higher. So that's the trend you're looking at. So you're basically trying to get in somewhere between here, and then you can ride the rally for the next 12 months. Okay, balance sheet, good amount of cash. It's going to have negative equity because they keep buying back shares, which is okay. So boycott in the Middle East area, 2.29% dividend, which is okay if you want to use options, and expecting some increase for earnings. So there is long-term options. And overall, they are targeting to expand 50,000 stores around the world. So it's just a matter of what price you can get into McDonald's. So ideally, I think you're going to try to get in at 280, 270. But if that is too aggressive and you don't think you can get it, then just try to get in around 290, 280. So I think that area will be what you're aiming for in the next couple of weeks. So the next stock is Starbucks for long-term investing. So it looks like MarketWatch has some data error. So I'm going to be using another website for this analysis. You can use investing.com if you want. So RSI is 56. So it's just turning bullish right after earnings. So the annual financials overall growing, but 2022 had a dip in profitability. So quarterly overall growing as well. So with China recovering, it is likely that Starbucks will continue to grow / breakout. So earnings, Starbucks blame the Israel-Hamas war for slower sales, but overall Starbucks is growing, which is why I believe the stock went up. So price forecast, likely bullish till late summer. In a bullish scenario, you'll likely reach 110 to 120 by autumn. All right, so Starbucks. So here you can see the trend itself is quite flat in the recent years, and they did go through a change in CEO, and I think the founding CEO, Howard, came back. So it's just a matter of providing performance to the investor and plus China recovery, because that's what Starbucks rely on for growth, and also apparently now Middle East. So here you can see the RSI just crossed the 50 threshold, and right now it's at 56. And the next level of resistance is 105. So I think if we're encountering a bullish scenario, you should aim to exit somewhere around 110 to 120. So I think it will break this upper high to this 110 level, which is this top, and potentially 120, which is close to the all-time high. So there is a good amount of potential increase here, upside. So medium trend, mature grants, overall growth despite the war, and I think the entry price is somewhere between 90 to 100, and the strike price you can use is 80. So here you can see I'm actually using a conservative strike price, 80, which is below the lower BB band. Now, if you want to use a more aggressive strike price and you feel confident, you can see there is actually a double bottom being formed here, and right now the momentum is in your favor, RSI above 50, so you can use 85. And if you want to go really aggressive, 87, but then I think 85 is pretty good, like it's already the lower parts of the Bollinger Band. 80, I would consider it to be conservative. So you can use 85, 87 if you want to. Insider, there's some sales with grants. Now, for the income statements, I couldn't find a good source that allowed you to compare because MarketWatch has some data error for this one, but we can just use it. So this is Seeking Alpha, and here you can see overall revenue is growing, so that's fine. Gross profit overall growing as well with some fluctuation here. This is the pandemic, if I remember correctly. And then for net income, overall growing as well. So it really bounced back from the pandemic, so I think that's okay. Quarterly. So for quarterly, this is the December number. Let me just highlight it properly. And they have a slightly off year end, so overall growing. So I think that's why it went up despite the war. And then gross income growing as well. And finally, go down to net income here, growing as well. So if you compare 855 to 1024, so that's growing. Now for Starbucks, if you look at the revenue, there is supposed to be some sort of fluctuation, and it did miss the sales for this quarter. So I think it's just going to be somewhere in the middle and then continue to go up. So I think if you want to invest now, it should be fine. And for EPS, similar trend. There is seasonality, and then they're expecting to have much higher profitability in Q3, Q4, excuse me. Now, in terms of balance sheets, you can see there's some data error here, but this is the December one, so that's fine. There's good amounts of cash. And liabilities is not showing properly, but they do have negative debt to equity. So let me just go down here. Total liabilities and equity is negative because they keep buying back shares. So it's very similar to McDonald's. Okay, so cut sales forecast, missed market expectation amid boycott. But McDonald's and Starbucks have like similar narrative, and both the stocks are going up. So I think it shouldn't be too big of an issue because the company itself is still growing when you look at the financials. 2.3% dividend. So you're really trying to capture this summer, late autumn to see if you can get to 110, 120. And there is long-term options as well. So I think if you want to use long-term options, January 2026, I think that's fine. So one thing I do want to mention about Starbucks is that you can see the trend itself is relatively flat. So that means you need to exit. So I think in the case where China recovers a lot faster than we expected, then perhaps you don't need to exit. But then I think if you want to be conservative, you should exit your options at 110, 120. And if you really want to keep Starbucks, then you can swap over to shares at that price. EG, already has shares, should I buy more shares? No long-term options. So drop 8% after earnings. Underwriting profits fall almost by a third, and 392 million reserve charge in its insurance operation. So this is a bit complicated, so I need to explain what this means. So underwriting is one of their arms, and the profit fell, which is normal. So if the profit falls, then the stock price goes down. Now, there's actually a positive 392 million reserve charge in its insurance operation. Now, for an insurance company, what they usually do is they get the premium and they set aside a certain amount of money as reserve. So that ratio is 87% for the company. And for the latest quarter, they lowered it to 86%. So they put aside less money, which means they're recognizing more profit this quarter. So they're recognizing 392 million more profit this quarter. Okay, so you can see, hey, the difference between 87 and 86, it can be manipulated. It is just an estimate created by management based on a lot of data, but a lower reserve leads to a boost in income. So they're putting less aside for potential loss. So this is also likely a one-off adjustment, And I think the reason why Wall Street was negative against it dropped 8% after earnings, was because they think management is being aggressive. So you can imagine if I lower the ratio from 87% to 80%, then I'm very aggressive. And if we excluded this one-off adjustment of 392 million, then the actual net income is 412, which is lower than last year, 496. So they actually have an overall decline in net income if we excluded this adjustment. So the price forecast will likely stay low until summer, so you have some time to find a good entry point. So you'll likely get a price between red blue EMA, which is 320, 350. So you can see there is a very large drop here, and right now it's 349. The Bollinger Band is slightly expanding, and usually with these kind of large drops, you wouldn't expect it to bounce back right away. So I think you have time to wait a couple of weeks to see if it goes to this red-blue EMA. And I think a next layer of support is just where these wicks are, between 340 to 330. So if it does stop around 330, 340, then I think, yes, you can enter as well. Now, when you look at the summary analysis, they do have strong trend. Early bottom because of the earnings drop, sell, and then the profit declined if you excluded the adjustment. So that's why I think Wall Street is being reasonable here. And there is no long-term option, so it's just stocks. So somewhere between 320 to 350 is okay. Insider, a little bit of grants, but mainly exercise. And then in terms of the financials, there is an overall growth, okay? And for net income, overall growth as well. Now, in terms of quarterly balance sheet, it's not really showing, so let me just go to here. So they have good amounts of cash, investments, because they're an insurance company. And then for debt to equity, it's here, around 3 times. And I think for insurance companies, they usually have a pretty good, a slightly higher debt to equity ratio, which is fine. So I'm not too worried about it. Okay, so analysts grill management on Q4 reserve charge, which is changing the reserve ratio. So this, I need to bring you over to the earnings report. Okay, so what they did is previous year they used 87.4 and now they're using 86.9. So they lower the ratio, which means they're putting less money aside for potential loss, which is why there is that boost in income on their financial statements. So let's see if I can just, I think it's at the bottom for the income statement. So if you look at the net income here, last year was 496 and this year is 804. So if you take out that change in reserve, which is 392, then that's where you have a decline in net income. So that's why the stock went down. So they have an increase in revenue, but they have a decline in income. So that's why there is such a large drop, and I think it might continue for a couple more weeks as well. So you can just wait for the RSI to come back above 40 or closer to 50 before entering if you want to be conservative. 1.97% dividend, and yeah, that's where I pull up the earnings. No options. Okay, so I think out of all the stocks, this one is the least mature, mainly due to a negative earnings where the stock price went down. So usually that doesn't reverse that quickly per se. Yeah, so if you want to invest in something else, like the ones I listed here, I think you will get to a profit faster. I think out of all the stocks I covered today, Crocs is probably the most interesting, where you want to enter before earnings. Ideally, you want to enter before the inflation number too. So next week you want to enter early into Crocs. Yeah, and then for Lulu, there's still some time before next earnings, so chances are for February it's just going to fluctuate. And Google will continue the trend, and I think Apple will start picking up in the next 3 weeks of February as well, up until the beginning of March. Okay, so that's it for this week's coaching call. Thank you very much for attending all the way till the end. I know you're the top 1% people that attended this webinar till the end, and you are very passionate about investing. I know you need help, then you can take investing to the next level. For that reason, please book a strategy session with me. We can have an in-depth discussion about your current situation and how I can help you. There are limited spots available to schedule a call with me, so then you need to act now and complete the application form so that I can review your situation and then we can have a chat for 45 minutes in the next couple of days. Thank you again for your time. I look forward to chat with you on the call.